I'm Nadia Daggett with Graystone Investment Group, where you invest and we do the rest. And I'm here today talking with Dario Jimenez from Mortgage Solutions team, and he is the team lead for his team. And he is one of the loan officers we work with for investment properties. And a lot of our mortgages that I've done have been through you. And so I highly recommend him. So I'm here talking with him today about what's going on in the market, especially with the COVID and not everything changing. So I'll let you take that over right there.
Cool. Well, thanks. Thanks for having me on, and I truly appreciate it. If we only knew exactly what was going on, we probably wouldn't be having any meetings, right? Yeah, I've done quite a few videos and talked to people about what's happening right now. Unprecedented time, right? This has never happened before in the history of our history, really, and we just don't know. So right now, everything's kind of going and playing by ear, so that every day something new is happening, right? So in terms of what's happening in the mortgage industry, we're just reacting to everything that the government is asking us to do, as well as some of the unintended consequences of some of the things that they have put in place that have kind of put a damper on some of our programs and nations. So it's an ever-changing process right now.
Yeah, and I've heard some other lenders, they had certain criteria that they were going off of, and then they have to go to 60%, but now they're going back up to 70. Is it kind of changing like that as well?
Yeah, so I've seen that quite a bit. I think my company's done a really good job at trying to limit the overreaction, so to speak. So where some of the other lenders you saw went to 660, 680, even 700 credit scores on their programs, we went up to 640, right, from 600. So a 40 point difference is, it's significant, but it wasn't 600 to 700, right? And that was we saw that happen with some of the other lenders. We saw some of the other lenders completely drop out or completely stop lending altogether. So those are the things that we've been seeing, and every lender reacting differently based off of their own circumstances, right? A lot of this has to do with their own liquidity, with the reserves that they have, how strong they are with their warehouse lines, things like that. So
Nice.
each lender's different.
Great. That's great. So what do you see what's going on with the investment loans going on right now? Like, do you see a lot of investors starting to be more active, or is it a little bit harder for them right now?
Honestly, with me and our business, because of the relationship that we have in Graystone, being so investment focused, I have not really seen a drop off in investor activity, but we do have limited products now, right? One of the things that happened one of the very first things that happened in the whole crisis, whatever we're calling this thing, pandemic, is that as soon as there was issues, the first people that pulled out their liquidity was the non-QM people. So non-QM loans are the bank statement loans, the investor cash flow loans, the foreign national loans, those types of things that don't fit within the Fannie, Freddie, Ginnie Mae bucket of regular traditional lending. Those people pulled out first. I don't want to say scared, but they were, let's say, reluctant to put up any more cash in case that something else even more drastic happened. I have heard that some of these guys are starting to come back into the market, so that we can start seeing some of these programs come back that will be able to help the investors a little bit more when they don't have all the traditional things that will help or that will fit the regular conforming lending boxes. So even in that space, the conforming lending, Fannie Mae, Freddie Mac, they actually pulled back and said, well, you know what, we're going to go to 80%, or we're only going to go to 75%, or sometimes, like you said, some. So there's going to be all those different things. Again, it's going to be based off different lenders. Right now, I want to say we're still at 80, but cash out, we're going to be going down to like 75 or even 70. And then where you're going to see some of those, the most, difference, okay, percent is going to be in rates, right? So cash out has always been a very risky loan because you're giving someone a whole bunch of
Oh,
money and
I
then
think
you
you're
don't know
frozen.
what they're going to do. They might, did I run? What?
Oh, yep, you're
Did I
good.
do? I'm good? Okay.
Yep.
Cash out loans have always been, riskier than normal loans because you're giving someone all this cash and you don't know if they're going to run to Mexico and never come back, right?
Hmm.
So for that reason, they're always priced a little bit higher than your regular purchase transaction or your rate and term transaction that's not giving you cash back. So when you have that situation, and then you combine that with the fact that Fannie and Freddie already said that they're not going to buy loans that were cash out in forbearance, then we're going to do what we need to do in order to price against that risk, right? So you're going to rate significantly higher than everything else in that space right
Ah, that makes sense. That makes sense. So one more question is, so how do you think the landscape's going to look in, say, 3 to 6 months? And
now.
this is a total guess because this is brand new and nobody knows
Right.
what's going to happen. But what is your take on it?
So I actually did an interview with the CEO of Union Home Mortgage, and he didn't even know, right? Our best guess is that all the GSEs, all right, the government sponsored enterprises, Fannie Mae, Freddie Mac, Ginnie Mae, and as well as the non-traditional non-QM lenders, I think all of them are going to start being a little bit more flexible in terms of what's happening with this pandemic, right? Biggest issue that we can perceive would be that there's people that have been without a job for 60 days, right, or maybe 90 days. It depends on when people start going back to work. And one of the things that we look for is continuous and stable employment. But if it was because of the pandemic, there might be some flexibility around that. There might be some flexibility around the fact that maybe a couple payments were missed here and there, or different things. I believe that with all the things, all the stimulus that the government's trying to do, that they're actually going to be able to be a little bit flexible in terms of lending as well.
Oh, that's good to hear. That's good to hear. 'Cause a lot of
We're,
people asking, a lot of
we're
investors.
praying.
Yeah, yeah. Never know, but that does make, I have heard that as well, so I am hoping that's a thing. Well, perfect. Well, thank you, Dario, for being with me today, and we look forward to working with you many, many more times. And could you tell us
Yeah.
your contact information?
Sure. It's Dario Jimenez. My phone number is 813-788-725. That is my phone. Call or text.
Perfect. And it's kind of cutting out just a little bit, so I'm going to make
Okay.
sure all his contact information is below, that you can contact him anytime. And he's wonderful to work with. He's one of our #1 lenders with Graystone, and we hope you get. I'll try to do this again with you, Dario, as time goes on, so we can keep everybody updated.
Sure. I look forward to it.
All right. Thank you, Dario.
Thanks, Nadia. Have a good one.
You too.
Bye-bye.